So here to share how he's positioning is Fundstrat Global Advisors Head of Research, Tom Lee. He is, of course, also a CNBC contributor. First off, Tom, I want to mark a milestone because it is now a big anniversary day for Fundstrat.
It is indeed. It's our 11th year since we started Fundstrat, which was September 15th, 2014.
Blink of an eye.
It's a blink of an eye, yes, because this is still mid-cycle for the bull market as well.
The conversation begins with a milestone moment. Tom Lee not only reflects on the growth of his own firm, but also makes a bold claim that markets are still in the middle innings of a bull cycle. This sets the tone for a discussion that weaves together artificial intelligence, interest rate policy, and even the rise of digital assets.
All right, so since you said mid-cycle for the bull market, let's get right into the record highs that we are seeing. If it's mid-cycle, that kind of implies maybe third, fourth inning, maybe fifth at the latest. Is that how you see things for this rally?
Yeah, I mean, I think some parts are later cycle, like part of the Mag 7 trade. But I do think AI still has many years to just propel earnings surprise and innovation and economic growth. So I don't think it's late, like it's too late. It's not too late to buy the Mag 7. But I think the next leg of this is really the Fed cutting, helps the ISM get back above 50, brings down mortgage rates, so it's a cyclical broadening trade. And then I think, financials, I think, are still important because I think that they're going to re-rate more like technology stocks. Goldman and JP Morgan are basically technology companies now. And as they embrace the blockchain, they're going to become more streamlined and less employee dependent, much more AI driven. So I think there's a lot to look forward to.
Lee stresses that even while some trades appear mature, the AI-driven growth story still has years to play out. He ties this not just to the obvious tech names, but also to financial giants like Goldman Sachs and JP Morgan, which he predicts will evolve into AI-powered, blockchain-driven firms. In his view, the bull market has broader foundations than many realize.
Now, if that is the case, you mentioned that it's because of a possible rate move lower and a trajectory of lower interest rates. Just how critical will it be to this market to have those lower interest rates? And do you think that there is a post-Fed playbook for what those companies are going to be?
Yes, I think it's really important for CEOs to be confident the Fed is cutting because we know the labor market has slowed, maybe even wobbling. And that's because businesses are cautious, and the ISM reflects it. It's been 31 months below 50. The Fed can actually re-inject confidence by saying we're back into an easing cycle. That helps businesses get confident and expand again. So there's a lot of legs to this if the Fed cuts, and I think it'll be a real improvement in liquidity.
The labor markets slow down, and weak manufacturing indicators weigh heavily on business sentiment. But Lee suggests that a pivot from the Fed could reset that psychology. Lower rates don't just reduce borrowing costs. They create an environment where CEOs feel secure enough to invest and expand. For Lee, confidence itself is a powerful force that can reignite economic growth.
You alluded to some of the places that could see the biggest impact.
Yes.
But can you take us through those? If you had to put a top three together about where you think the most activity or juice could come from if the Fed were to embark on this path. I think of maybe home builders. I think of other parts of the market, maybe technology based on valuations. But in your mind, what are the places that are going to reap the most benefit from that?
Yeah. So I'm looking at September 98 and September 2024 as the playbook, because those are both years where the Fed was on extended pause and they cut in September. The number one trade is NASDAQ 100. So I think that's why the Mag 7 and the AI trade gets a lot of lift off. The second is monetary liquidity sensitivity, global central banks easing. That's Bitcoin and Ethereum. And seasonally strong, I think they could make a monster move in the next 3 months, like huge. And the third, of course, is interest rate sensitives. That's really small caps and financials. But really, the first two might be the standout trades.
By drawing parallels to 1998, Lee identifies the trades that could benefit most if the Fed cuts rates: big tech, cryptocurrencies, and small caps. But he makes it clear that AI and crypto stand above the rest, capable of delivering outsized returns in a liquidity-fueled environment. This comparison roots today's market in a broader historical cycle.
All right. Because you mentioned the crypto side of things, you're actively involved now. It's not just a thing that you're doing on the side. You are very much engaged in the business of crypto. You govern, you oversee crypto assets now. If we were to say Ethereum, Bitcoin, we try to bucket them into risk-averse assets or risk-on type assets.
Yeah.
Is it fair to look at them that way? We used to compare them correlation-wise to the NASDAQ 100. Is that the fair assessment for how these things trade in the coming months?
Yes. Bitcoin is particularly monetary policy liquidity sensitive. Ethereum has elements of being sensitive to liquidity, but it's also part of this AI moving onto the blockchain and Wall Street moving onto the blockchain and that whole stablecoin ChatGPT moment for crypto. So Ethereum, I think, trades almost like 1971 Wall Street, which was the dollar went off the gold standard, a lot of innovation. Ethereum essentially is a growth protocol, and that's why Bitmine is so aggressively acquiring Ethereum.
Lee shifts from macroeconomics to crypto, highlighting Bitcoin's sensitivity to liquidity and Ethereum's unique role in blending blockchain with AI. By likening Ethereum to Wall Street in 1971, when the dollar abandoned gold and innovation surged, he frames it as more than a digital currency. It's a growth protocol and a platform for financial reinvention.
I think the next leg of this is really the Fed cutting, helps the ISM get back above 50, brings down mortgage rates, so it's a cyclical broadening trade. And then I think, financials I think are still important because I think that they're going to re-rate more like technology stocks. Goldman and JP Morgan are basically technology companies now. And as they embrace the blockchain, they're going to become more streamlined and less employee dependent, much more AI driven.
This return to financials underscores his belief that banks are on the brink of reinvention. Through AI adoption and blockchain integration, Lee envisions financial institutions trading more like tech firms. The implications are clear. What has traditionally been considered a slow-moving sector could soon resemble the dynamism of Silicon Valley.
Ethereum has elements of being sensitive to liquidity, but it's also part of this AI moving onto the blockchain and Wall Street moving onto the blockchain and that whole stablecoin ChatGPT moment for crypto. So Ethereum, I think, trades almost like 1971 Wall Street, which was the dollar went off the gold standard, a lot of innovation. Ethereum essentially is a growth protocol, and that's why Bitmine is so aggressively acquiring Ethereum.
Ending with Ethereum again ties Lee's themes together: AI, blockchain, liquidity, and financial transformation. His conviction that Ethereum will lead the charge into a new era reinforces his broader bullish outlook on markets, technology, and innovation. Stepping back, Tom Lee's analysis paints a sweeping picture of opportunity. He reminds us that despite fears of a late-cycle market, we may only be halfway through. AI continues to be a driving force, not just in technology, but also in reshaping financial institutions. Rate cuts from the Fed could spark renewed confidence, fueling everything from homebuilders to small caps. And perhaps most boldly, Lee places cryptocurrencies, particularly Bitcoin and Ethereum, at the heart of this story, suggesting they could define the next leg of global financial growth. By comparing Ethereum to a seismic historical shift like the dollar leaving the gold standard, he highlights the magnitude of what might lie ahead.
Ethereum essentially is a growth protocol, and that's why Bitmine is so aggressively acquiring Ethereum.
Now it's time to hear from you. Do you think Lee is right that AI and Ethereum will fuel the next great market boom? Or is this optimism overlooking serious risks? Let us know what you think in the comments below.